Thursday, May the 13th, 2025. Welcome, everyone, to the 37th edition of Well Daily Brief. Let's kick things off with a financial fact that, well, it might just raise an eyebrow. Picture this. Around 60% of young working Indians, or millennials, are choosing to invest less than 10% of their earnings in the stock market.
That's quite something, isn't it?
It really is. They're flocking to what they see as, the safe havens, real estate, and gold.
Right.
Even though history largely suggests that, well, the long game in stocks has often delivered higher returns.
It certainly paints an interesting picture of how a significant portion of the new generation views wealth building and risk, I suppose.
Exactly. Makes you wonder about the current investment mindset.
It does. Now, shall we dive into how the markets actually performed today, based on the closing bell, of course?
Let's do it. So, as of 3:03 Euro PM India Standard Time today, May 13th, 2025, Nifty 50, it ended the day at 24,593.65.
Okay.
That's a decrease of 1.33%.
Bit of a pullback there.
Yeah, but here's where it gets interesting. While the big guys took a dip, the Nifty Midcap 150 actually bucked the trend.
Oh, why did they do?
Closed up by a solid 0.27% at 20,385.955.
Interesting divergence.
And it doesn't stop there. The smaller players, the Nifty Small Cap 250, they showed even more enthusiasm, climbed 0.84% to finish at 15,815.45.
Wow, so strength in the smaller segments.
Definitely. But the broader Nifty Total Market Index, well, that kind of mirrored the large caps, ended down by 0.64% at 12,560.37.
So a bit of a split decision across the market today, as you said.
Exactly.
It signals that while the larger, more established companies face some headwinds, there's still, strong underlying momentum in the mid and small cap parts of the market.
Makes sense.
What about the bond market and the rupee's performance?
Good question. The 10-year Indian bond yield actually eased slightly, down to 6.339%.
Okay, eased slightly.
Yeah, this small dip suggests continued investor confidence in the Reserve Bank of India's bond buying program.
Right, the RBI stepping in.
Think of it like this. The RBI is buying bonds. That increases demand and, in turn, helps keep those yields stable. Generally a comforting sign for the market, wouldn't you say?
Absolutely. It provides that stability. And the currency markets. How did the Indian rupee fare against the U.S. dollar?
Well, there, the INR weakened a bit, closed at 85.41 against the USD.
85.41.
Yeah, that's about a 0.55% slip. The main driver here seems to be renewed outflows from foreign institutional investors, the FIIs.
FII outflows. That usually puts pressure on the rupee.
Exactly. When these big international investors pull money out, it tends to create that downward pressure.
Okay, so that gives us a good snapshot of the day's numbers. Now, what were the key news stories bubbling up today? The things likely influencing these market moves?
Oh, loads happening. For starters, we saw the Sensex take a tumble, over 900 points.
Oof, drop.
And the Nifty dipped below that 24,750 mark. The main reason. Well, it seems like many investors just decided it was a good day to cash in some profits.
Profit taking, okay.
Particularly in the IT and banking sectors, which, had seen a pretty strong run recently.
Right. After a good climb, people pause to catch their breath, maybe take some money off the table.
Exactly that.
Profit taking after gains is, well, a very natural part of market dynamics. Were there any other significant news items catching attention?
Yes, indeed. While the ceasefire between India and Pakistan seems to be holding, which is good news.
Definitely good news.
There's still this kind of lingering sense of caution among investors, mainly due to those potential tariff threats from the United States.
Right, the trade tension uncertainty. It's like a distant rumble of thunder, isn't it?
It is. You're hoping the storm passes, but you're still a little on edge.
Yeah.
And on the domestic front, Indigo, the airline,
yes,
they had to cancel some flights at 6 different locations, some operational hiccups, and that had a bit of a knock-on effect on travel-related stocks.
Sure, operational issues in key sectors like airlines can certainly create ripples. What about any positive news? Anything that stood out?
Absolutely. The tech world is buzzing. Sony launched its brand new flagship smartphone, the Xperia 1.7.
New tech launch.
Yeah. And this really highlights the growing dynamism, the potential of the Indian consumer electronics market, shows the increasing appetite for cutting-edge tech here.
That's a positive sign for consumer spending.
Definitely. And for something a little different, the social media buzz around the upcoming IPL 2025 schedule is really picking up steam.
Ah, cricket season anticipation.
You got it. And that's generally a positive indicator for media and entertainment stocks. Cricket and commerce in India, it's always a winning combination.
Always. Okay, let's maybe delve a bit deeper into some of that specific financial and economic news. You mentioned profit-taking hitting the Nifty 50, particularly in IT and banking. What's the underlying story there?
Right. So as we noted, the Nifty 50 saw that 1.33% decline. And some of the big names leading that downward trend were Infosys and TCS in IT,
The heavyweights.
and HDFC Bank in banking. Analysts are suggesting that after the gains we saw on Monday, the market might have become a little, overbought.
Okay, overextended perhaps.
Exactly. Think of it like a stretched rubber band. It can only go so far before it needs to snap back a bit.
Makes sense.
And this feeling of potential overextension, it's also reflected in the India VIX. It jumped by a notable 5%.
The fear gauge, up
Yeah.
5%. That's significant.
It is. The VIX is essentially our market nervousness gauge, so a rise there tells us there's increased anticipation of price swings ahead, volatility.
Okay. And how are the RBI's ongoing bond buying operations influencing things right now? You mentioned they support yields.
Well, the RBI is definitely continuing its efforts. They're ensuring there's enough liquidity in the financial system. They purchased a significant $750 billion worth of government bonds just this week.
$750 billion. Wow. That's quite an injection.
It is, and this consistent buying pressure is a key reason why that 10-year bond yield has remained relatively stable around that 6.339% mark we mentioned. In fact, Bank of Baroda is even forecasting that we might see these yields ease further, potentially settling in the 6.30–6.35% range for the rest of the month.
So the RBI is actively managing things, keeping borrowing costs contained.
Precisely, strategically managing the flow of money.
Interesting. Any developments on the international trade front? Something investors should be keeping an eye on.
Yes, actually some positive movement. The negotiations for the India-UK Free Trade Agreement, the FTA.
Ah, the FTA talks. How are they going?
They seem to be progressing quite well. There's increasing optimism, that we might see this agreement finalized and signed maybe as early as the third quarter of 2025.
Q3 2025, that would be significant.
Absolutely. It could be a real shot in the arm for certain sectors, particularly textiles and pharmaceuticals.
Key export sectors for India.
Exactly. So for our listeners who are NRIs and maybe have an eye on investment opportunities back home, these are definitely sectors to watch closely.
Good point. That's certainly encouraging news with potential long-term benefits. Now, what about precious metals? Gold, specifically.
Gold continues to shine brightly. Prices surged today, a healthy 2%.
2%? Wow. Where did it reach?
Up to 73,500 per 10 grams.
73.5. Strong move.
Yeah, and this rally is largely being fueled by what we call safe haven demand.
Right, the flight to safety when markets get jittery.
Precisely. When there's uncertainty in global markets, trade tensions, economic jitters, whatever it is, investors often flock to gold as a store of value.
Makes sense.
So for those of you looking to add some diversification to your investment portfolios, maybe considering gold ETFs could be a smart move.
Good suggestion. Exposure without the hassle of physical storage.
Exactly.
And finally, let's touch upon the Indian startup ecosystem. We've seen so much activity there. What's the latest vibe?
Indeed. Well, the pace of funding for Indian tech startups seems to have slowed down somewhat.
Oh, slow down.
Yeah. In April 2025, the total funding raised was about $800 million. Now, that represents a 33% drop compared to the previous month.
A third less funding month on month.
It likely reflects a more cautious stance from investors, in the current global economic climate.
Understandable.
Yeah.
But are there still bright spots?
Oh, definitely. It's fascinating to note that even with this overall dip, fintech and artificial intelligence, AI, they continue to be the sectors attracting the lion's share of venture capital.
So fintech and AI still hot.
Absolutely. So while overall funding might be down, these high-growth areas remain firmly in the spotlight.
Okay, that's a really comprehensive overview of the key financial and economic forces at play today. Now, let's maybe shift our focus. What does all of this mean for the market outlook? And how might you, our listener, be thinking about navigating these currents?
Okay, let's try and break it down. Today's market action was certainly a mixed bag. We saw that correction in the main indices, right?
Right, the Nifty 50 down.
Driven by profit-taking in those heavyweight stocks and some renewed FII outflows, as we discussed.
Yep.
And here's where it gets really interesting. The mid-cap and small-cap segments showed surprising resilience, actually ended the day in positive territory.
That's the key takeaway, the divergence.
It really is. Meanwhile, the rupee weakened, likely on those FII concerns. While the bond market seems to be finding stability, largely thanks to the RBI's interventions, it's a market with, well, different stories unfolding simultaneously.
Definitely feels that way. So if we step back and look at the broader economic picture, the macro landscape, what are some of the key factors at play right now?
Well, that ongoing bond buying program by the RBI, it's really acting like an indirect easing of monetary policy.
A sort of de facto rate cut.
You could almost put it that way.
Yeah.
And that's generally good news for sectors sensitive to borrowing costs, like banking and real estate. Like the RBI is gently, greasing the wheels of the economy in those areas.
Makes sense. But there are risks too, right?
Absolutely. We can't ignore the potential headwinds, those U.S. tariff threats we mentioned, and the risk of a slowdown in global demand. That could certainly cast a shadow on our export-oriented industries. On the brighter side, though, the progress with the India-UK FTA is a definite positive. That could give a boost to corporate earnings down the line, maybe in FY26.
Okay, so a mix of potential positives and negatives. What about growth forecasts?
Well, Goldman Sachs is still forecasting a pretty healthy 6.8% GDP growth for India this fiscal year.
6.8% is solid.
It is. But the fact that inflation seems to be sticking around the 5% mark might mean the RBI will be cautious about making any aggressive interest rate cuts in the near future.
Right. Inflation watch continues.
Exactly. And just a note for our NRI listeners keeping an eye on currency movements, Morgan Stanley's forecast, they see the INR potentially weakening further, maybe to the 85.586 range by the end of the year, something to keep in mind for investment planning.
Good point on the currency for NRIs.
Yeah.
Okay, so zooming in on specific sectors now. Based on today's trading and the news flow, what are some key insights?
All right, let's take a closer look. In the banking sector, despite today's slight pullback, the large private sector banks think HDFC Bank, ICICI Bank, they still appear to be pretty attractive options.
Why is that?
They're demonstrating good credit growth, and the expectation of eventual interest rate cuts should provide a further tailwind down the road. The key here, though, is to focus on banks that have a solid track record of managing their non-performing assets, their NPAs, effectively. The bad loans.
Right. Asset quality is crucial in banking. What about the IT sector? It saw some of that profit-taking today.
That's right. Concerns about potential margin pressures and maybe a slowdown in global demand.
Yeah.
They're definitely creating some headwinds for the giants like TCS and Infosys.
So caution there.
A bit, perhaps. If you're looking at the IT space right now, it might be prudent to favor companies that are strategically focusing on emerging tech like AI and cloud computing. HCL Tech, for instance, is often highlighted in that context.
Okay, focusing on specific niches within IT. Now, what about the mid and small cap segment? They showed that surprising strength today. What's driving that performance?
Exactly. That outperformance seems to be fueled by strong domestic investor interest. DII flows, basically.
Domestic money flowing in.
Yeah, particularly into sectors tied to India's internal growth story. Think infrastructure development, consumer durables.
Makes sense.
Yeah.
Any specific areas?
Well, there could be some interesting selective opportunities, maybe in areas like renewable energy. Perhaps a company like Suzlon comes to mind, and also in the logistics sector, which is, crucial for supporting India's expanding economy.
Okay, selective stock picking there. How should investors be thinking about the pharmaceutical sector in this environment?
Pharma always has its own dynamics, doesn't it? While there are those ongoing concerns about drug pricing in the U.S. market,
Always a factor.
companies with a strong focus on generic drugs like Sun Pharma tend to be a bit more resilient to these pressures.
Generics focus helps.
It can. And for those seeking broader exposure to the sector, maybe pharmaceutical ETFs could be a consideration. Diversifies the risk a bit.
Good option. And finally, the consumer goods sector. What's the outlook there?
Well, the upcoming festive season in India is always a significant driver for FMCG companies. Think Dabur, companies like that.
A stiff demand boost.
Exactly. The key factor to watch here, though, is the recovery in rural demand, which has been somewhat uneven recently.
Right, rural recovery is key.
It is. But on a positive note, stable input costs are helping to improve the profit margins for these companies. So that's a plus.
Okay, so based on all these insights, sector by sector, what would you say are the key investment themes that are currently emerging? What should listeners be thinking about?
Okay, several compelling themes seem to be taking shape right now. First, I'd say rate-sensitive growth.
Banking and real estate.
Exactly. As the RBI's actions effectively ease monetary conditions, those sectors are poised to benefit. A Nifty bank ETF, or perhaps a well-managed bank like Kotak Mahindra Bank, could be avenues to explore there.
Okay, theme one, rate sensitivity. What's next?
Second, export opportunities. With that India-UK FTA potentially on the horizon,
Textiles, pharma.
right, those sectors could see a significant boost. The Nifty Next 50 index might offer some exposure to promising mid-sized, export-focused companies. Worth a look.
Got it. Export focus. Third theme.
Third, safe haven assets. Gold's recent surge really underscores its role, doesn't it, as a valuable hedge during times of uncertainty.
Absolutely.
So considering gold ETFs or maybe even sovereign gold bonds could be a way to incorporate that stability into your portfolio.
Makes sense. Safe havens. Number 4.
Fourth, the digital economy. Look, despite the recent dip in overall startup funding, the long-term growth story of AI and fintech in India remains incredibly compelling.
Still a major trend.
Definitely. Listed tech companies, even those in adjacent spaces like Zomato, could offer exposure to this ongoing trend.
Okay. Digital India. And finally,
Infrastructure. The government's continued emphasis on infrastructure spending, the CapEx push, that should provide a tailwind for mid-cap companies in this sector, makes the Nifty Mid-Cap 150 an interesting option to consider.
great summary of key themes. Rate sensitivity, exports, safe havens, digital, and infra. Now, given the inherent volatility we're seeing, what kind of risk management strategies would you recommend for our listeners?
Risk management is absolutely paramount. Can't stress that enough. For a sort of well-rounded approach, a general guideline might be to allocate, say, around 60–70% of your equity portfolio to large cap stocks.
For stability.
Exactly. And then maybe 20–30% in mid and small caps for that potential higher growth, but understanding the higher risk too.
Balanced allocation. What about hedging?
Good point. Given the ongoing global uncertainties, trade risks, slowdown worries, it could be prudent to hedge a portion of your portfolio. Using instruments like gold ETFs, as we mentioned, or even debt funds can help cushion potential downturns.
Okay, hedging is important. Anything else to watch?
Definitely keep a very close eye on the signals coming from the U.S. Federal Reserve and, of course, the RBI's June policy meeting. Look for any hints about future interest rate movements. That will be key.
Fed and RBI meetings, noted.
And just a word of caution, particularly for our retail investors. It's generally wise to avoid taking on excessive leverage, especially in the more volatile small cap space. Valuations there are looking a bit stretched right now, with price-to-earnings ratios around 24 times.
Right, avoid over-leveraging in frothy segments.
Exactly. It's all about balancing that potential return with managing the potential risks involved.
That's sound practical advice for navigating today's market. Now, let's shift gears a bit and turn our attention to something that unfortunately still exists in the stock market, the practice of bear rating.
Ah, yes, the murkier side of the market. Bear rating. It's essentially a manipulative tactic, isn't it?
It really is.
Where individuals or groups aggressively bet against a company's stock by short selling it.
Right, selling shares they don't own yet.
While at the same time spreading negative and often completely fabricated rumors, all in an attempt to drive down the stock price so they can profit from their short positions.
It's a calculated effort to create panic and then profit from that panic.
Exactly. Pure manipulation.
Could you explain a bit more about how this actually operates? How do they pull it off?
Certainly. Here's how it typically unfolds. First, the perpetrators will borrow shares of the company they're targeting. Think of it like renting them.
Okay, borrow the shares first.
Then they flood the market by selling these borrowed shares. That creates immediate downward pressure on the stock's price just due to the increased supply.
Selling pressure.
Simultaneously, and this is the really manipulative part, they orchestrate the spread of negative news. It could be anything. Completely false claims about the company facing financial ruin, made-up regulatory troubles.
Baseless rumors.
Exactly. And these rumors are often amplified through social media, online investor forums, maybe even whispered through unofficial channels.
Spreading like wildfire.
Right. This barrage of negativity creates fear and uncertainty among existing shareholders. That leads to widespread panic selling, which, of course, further accelerates the stock price decline.
A vicious cycle downwards.
Precisely. Once the prices drop significantly, the bear raiders then step in and buy back those shares at the much lower cost. They return them to the original lender and pocket the substantial difference as profit.
And who are the typical targets?
Sadly, it's often mid and small cap companies, especially those with lower trading volumes, lower liquidity, or perhaps perceived weaker underlying financial health. They're just easier targets for this kind of malicious manipulation.
Makes sense. So for our listeners, what are some of the red flags, the warning signs that might suggest a stock is being targeted by bear raiders?
Okay, there are several telltale signs to be vigilant for. One of the most obvious is a sudden, sharp drop in a stock's price, especially when it seems completely unexplained by fundamentals,
Out of the blue drop.
and particularly when it's accompanied by a significant and unusual increase in short-selling activity. You can often track that short interest data.
High short interest plus price drop. Okay.
Also, be very cautious of negative rumors that start circulating without any credible sources. No official confirmation from the company itself or from regulatory bodies like SEBI.
Unverified rumors are a big red flag.
Huge. Another one is seeing coordinated and aggressive campaigns on social media platforms, forums, Twitter, WhatsApp groups, all pushing a negative narrative about one specific stock.
Coordinated online attacks.
Exactly. And sometimes, they're not always, after that initial dramatic plunge, you might witness a very rapid, almost artificial-looking price recovery. That can also be an indicator of this type of activity wrapping up.
Okay, good signs to watch for. Most importantly, what steps can individual investors take to protect themselves? How do you avoid becoming a victim?
Right, protection. The best defense is always to be a well-informed and rational investor. First and foremost, always verify any news or rumors you come across.
Verify, verify, verify.
Use reliable and official sources.
Okay.
Company filings with the stock exchanges, NSE, BSE, announcements directly from SEBI. That's where the real information is.
Stick to official sources.
Absolutely. Second, resist the urge to make impulsive decisions. Don't panic sell your shares based solely on unverified rumors or social media chatter. Take a breath.
Avoid panic selling.
Crucial. Very. Third, keep an eye on the short interest and trading volumes of the stocks you hold. This info is usually publicly available on the exchange websites. It gives you context.
Monitor the data.
Fourth, if you ever feel uncertain or panicked by unusual market activity in a stock you own, don't hesitate to consult with a registered financial advisor. They can provide objective guidance.
Get professional advice if unsure.
Definitely. And crucially, fifth, if you do come across market activities that seem suspicious or manipulative, report them. Report it to SEBI or the respective stock exchanges. They need to know.
Report suspicious activity, yes.
Vigilance and, honestly, a healthy dose of skepticism are your best allies in these situations. Don't just believe everything you read online. Promotional message. Hey there. Quick question. Are you sometimes finding it a bit of a challenge to keep up with the fast-paced world of Indian finance? Do you ever feel like maybe you're missing out on crucial insights that could impact your investment decisions? If that sounds familiar, well, you're definitely in the right place. Welcome to Finwell Daily Brief. We like to think of ourselves as your daily shortcut to staying informed and, more importantly, empowered in the Indian financial markets.
That's right. We really understand that your time is precious. That's why we meticulously sift through all the noise out there, analyze the key market movements, the economic trends, and then deliver them to you in a concise, easy to digest, and engaging format.
Exactly. Imagine starting your day with a clear understanding of what happened in the markets yesterday, what's driving those movements, and what potential opportunities and risks might lie ahead. All in one brief update designed specifically to save you valuable time and keep you ahead of the curve.
Don't let information overload hold you back from achieving your financial goals. Why not subscribe to Finwell Daily Brief today? Take control of your financial knowledge.
Please do. And for even more in-depth discussions, ongoing analysis, and to connect with a community of informed investors just like you, be sure to follow SOS Finwell on LinkedIn.
Yeah, we're building a vibrant community over there, and we genuinely love for you to be a part of it.
So go ahead, subscribe now, and let's navigate the exciting world of finance together. And now, as we wrap up today's 37th edition of Finwell Daily Brief for Tuesday, May 13th, 2025. Let's just quickly recap the key takeaways from today.
Good idea.
We witnessed that market correction, didn't we? Nifty 50 down 1.33%, largely driven by profit-taking, especially in IT and banking.
Right, but with that notable strength in mid and small caps.
Exactly. They actually closed in positive territory. Meanwhile, the RBI's ongoing bond buying efforts continue to provide support to bond yields, keeping them stable.
While the Indian rupee experienced some weakening against the US dollar, likely due to those FII outflows.
Correct. We also discuss both the positive catalysts on the horizon, like the progress with the India-UK FTA, and maybe the anticipation around the upcoming festive season.
As well as the potential headwinds, like those US tariff threats and the risks associated with a global economic slowdown.
So putting it all together, our investment focus for today really centers on fundamentally strong large-cap banks, looking for selective opportunities within that resilient mid-cap space.
And recognizing the continued role of gold as a valuable safe haven asset within a well-diversified investment portfolio.
Absolutely.
Indeed. It's definitely a market characterized by both compelling opportunities and inherent risks. It really emphasizes the need for thorough analysis and, a well-balanced investment strategy.
Well said. And on that thoughtful note, we'd like to leave you today with a timeless piece of wisdom from the legendary investor, Benjamin Graham.
Ah, good old Ben Graham.
He said, "Investing is not about beating others at their game. It's about controlling yourself at your own game."
Wise words. Controlling your own emotions and decisions. Crucial.
So true. Thank you so much for tuning in to this 37th edition of FinWell Daily Brief.
Yes, thank you, everyone.
We'll be back with you tomorrow with all the latest updates from the Indian financial markets. Until then, happy and informed investing.